Okay. So I know that today is a big day in school, right, for accounting majors. It's the accounting fair, and a lot of people are there. So I completely understand, and those who are here with me, I understand even more. Our designated videographer was not available for today, and I got very concerned because I know a lot of people would miss this class, and I want to make sure it's recorded, so I had asked Mr. David to be so kind to come in and record, and he's here, which all of you will be able to benefit also by viewing the recording of this lecture. So how about a round of applause for Mr. David? For saving the day. All right. So those of you who missed the first class, you've missed so much you have no idea. Am I right or am I right? Absolutely. So we had a lot of fun. We covered a lot of material. So, but the good news for you is that I had that class recorded, video recorded. So the videographer told me the video will be ready sometime next week, and I'll post it on Blackboard. So those of you who missed it, make sure that you very thoroughly, carefully watch the video of the first class as soon as possible, because I invested tremendous amount of time in discussing the housekeeping items, the structure of the course, the expectation, what, how. So you know, you're not lost, we don't go in cycles, and you don't miss major opportunities and don't make silly mistakes. Now, I know bookstore, as sometimes happens, messed up with the books, meaning they ran out of them. I don't know if that's messed up or not, depending on who you speak with. If you ask me, they messed up. They know the enrollment, so they should know them. But in any case, my understanding is that the book is back in the bookstore downstairs. And this is how it looks. You know, the few of you emailed me with questions. Bookstore always had all this information months ago. But those of you who still didn't get the message, this is how it looks. You could buy the hard copy. It's this big. But again, you know, I know a lot of you concerned about money. This is, you know, if you invest into this book, you cover many, many birds, or kill many birds with the same stone. First of all, you could cancel your gym membership after this, because when you walk around with this book, you don't have to work out. Second of all, this is a great self-defense mechanism. If you knock somebody out, they're going to be done for a while. And I'm sure you could think of many other uses for this book. So you have to have a book. I don't care what version, excuse me, what format. You could get digital copy, you could get hard copy. That I don't care about. What I do care about, that you get the right book with the right year, 2019 edition. Okay? I know 18 is cheaper, but it's just wrong stuff, and the law has been drastically changed. So you're just going to work with the wrong material, wrong information. If you come to me at any point saying, oops, I was doing homework with the wrong questions, the wrong problems from the wrong book, my answer will be, oops, you should not have done that. Okay? So with that in mind, again, I encourage all of you to review the video, and certainly those of you who were here, your notes. And I want to remind you to take very good notes, because the best way to prepare for the exams and the best material that you could use for the preparation of exam are my notes. So if I talk about something, I'm going to test it, most likely. And if I don't discuss something, I will not test it, definitely. And if I spend more time on something, it means it's more important, therefore you should know it more. I'm likely to test it more. Okay? So quick recap of last class before we move on to bigger and better things. We talked about the history of tax. We talked about why it's all about, why there's such a headache, why at the end of the day it's really the only way for the government to survive, because this is how the government gets money to pay for all its activities, including salaries for important people in the government, including the president, interns, and everybody else. Also all the government expenditures, including highways, certain social programs, infrastructure, healthcare, redistribution of wealth. We talked about the causes, but also some of the other ways why and how the government uses tax system. And we talked about redistribution of wealth, again, taking some money from those who have more, giving it to those who have less, whatever those reasons are. Also encouraging or discouraging certain behavior. You know, we give tax less certain activities, maybe today the example of that, and we want to discourage certain activities. So if you're smoking, you know exactly what I'm talking about, because there's a cigarette tax and all the other stuff. And of course, historically, government used taxes also to put bad guys in prison, because it's very difficult to prove that they committed crime, right? So what is the most famous guy that we talked about? What's his name again? Al Capone, right? Mr. David knows. So, you know, it was very tough to put him in prison, because anybody whom they ever would try to get to testify against him would get killed the next day, right? So ultimately it's about taxes, and it's about tax evasion, and we talked about the concept of tax evasion, and very important to stress the difference between tax evasion and tax planning, right? The difference being whether or not you want to sleep well and sleep at home or be in prison, right? One is legal, the other one's illegal. And we'll explore this, you know, but breaking laws are not legal, but planning transaction to minimize how much you're paying to the government is very legal. In fact, I'll tell you that when taxpayers came into business originally, suggesting to people what they could do to pay less taxes. And we'll see a lot of examples of that. We even talked about some of these examples last class, if you remember, right? But you don't know what I'm talking about. So when we talked about, for example, standard deductions, right? Remember? We talked about you get certain benefits if you're in certain category, right? 65 or blind, right? So if you want to talk about tax planning, we talked about these couples, and we'll come back to these conversations some other time. But the important thing is the IRS had a problem with taxpayers. And some of you may be sitting there thinking, wait a second, it doesn't sound too right to me. I mean, is it ethical? Is it legal to pay less taxes, to plan, you know, your transactions? And it's difficult for you to appreciate the planning concept again. You'll see it more and more with every class. But, you know, some of you may be sitting and wondering, you know, is it ethical? And IRS had a major problem with it. In fact, IRS came out outright and said, all the tax planners are illegal, because what you do, you help people pay less money to the IRS, and because of it, the government has less money. And guess what? There was a litigation, right? Because anytime we disagree in this society, we do what again? We go to court, right? We sue each other. So it went all the way to Supreme Court. You know what Supreme Court is? It's like the highest court. All these oldest people in the country. Right? So they're sitting there forever till they die, and they decide what cases to take, what cases not to take. And there was a very famous guy, brilliant guy in the Supreme Court at that time, Oliver Wendell Holmes. Okay? I'll come back to this name throughout the course, because he's just an amazing guy. He was actually dean of one of the law schools in New York City for a while. And he made these just astonishing statements and decisions using very basic propositions. But in this particular case, when IRS was trying to shut down entire industry, Supreme Court agreed on very simple proposition. And Oliver Wendell Holmes, in his famous opinion, basically said, hey, if your neighbor pays more taxes than you do, it does not make him any more patriotic, pretty much, in that sense. In other words, they said in that opinion that taxpayers, U.S. citizens and residents, because you don't simply have to be a citizen to pay taxes, even if you have a green card, did you know that? You have to pay taxes? How many of you knew that? Right? Now, how many of your relatives who have green cards knew that? Okay, let me rephrase the question. How many of your relatives who have green cards who knew that and actually paid taxes? Okay, now did you know that once you're a citizen of the U.S., you have to pay taxes on your income from entire worldwide operations? Did you know that? Doesn't matter where it takes place. It's very interesting. It's the price of being a U.S. citizen. Okay? And green card ultimately gets you to the same place. So going back, what they said is, hey, it's okay, tax planning is fine, you could pay less taxes as long as you don't break the laws, as long as you plan your transactions in a way that minimizes tax following the rules of taxation. Okay? So, and we'll talk about more and more examples, but this is the beauty of the tax world, because this is where the real creativity, the real expertise, the real value that you could create for yourself and for your clients and for your employees and for your boss and for your company, because through tax planning, this is where the major tax savings happen. And depending how you look at it, as I said last class, to me, tax planning is really an alternative form of investment. Okay? Because you could make money in the market, you could make money in the business, or you could also make money paying less taxes. And sometimes you make much more by paying less taxes than you could make in the market. Because the rates, as we discussed last class, and we'll look at them today, 30, 40% pretty much taxes. So if you could minimize or pay no taxes, and I'll teach you during this course how you could make a lot of money, including hundreds of thousands of dollars, and pay no taxes at all. It's crazy. But there are provisions in tax code for those who know them. You'll have to pay, of course, extra for that information. No, kidding. But yeah, real stuff. So it's okay to do tax planning. There's nothing unethical about it. Okay, as long as you do it legally. So to do things legally, you have to know the laws. Okay, and this is what you're going to study in this class. And this brings me to the next point, that tax is law, which is very different from science. Because in law, as I said last class, quite often there is no clean, clear, bright yes or no answer. Okay? Quite often, the most important answer is what? It depends. See, I could tell who were in last class and did not sleep through. All right, so we talked about that. We talked about the role of the IRS as enforcement. We talked about how they make sure you pay taxes. They audit you, how they audit you. We talked about random selection. We talked about, you know, these system errors or disconnects when information that IRS receives does not match the information that you supply. It triggers audits. We also talked about people who report on you, right? The whistleblowers. And we talked about top 3 categories, being number 3 being former employees, disgruntled employees, usually those who are very unhappy. Number 2, your neighbors. And what's number 1 again? Ex-spouses. Ex-spouses and ex-girlfriends, right? Which again brings me to remind you to put your personal lives on hold completely. Nobody's getting married, nobody's getting engaged. Nobody's even getting divorced, by the way, although we'll talk about divorces. Very important to get divorced this year, for those of you who are considering. And I'm not kidding. Because after this year, you will not be able to deduct, as a general rule, alimony payments. Okay? It's a big deal. Those of you who got divorced already, that's another reason to be happy about it. Okay, and those who did not divorce, I seriously encourage you to think about it. Because chances are you will soon, right? Statistically speaking, you might as well do it and get tax benefits. So we could talk more about these things later. Anyway, so I want to continue our conversation that we started in chapter 3, and that's the tax formula. Because this is what it's really all about. And again, tax formula is the structure that we'll go through the entire semester, and we're going to zoom in on different line items. Okay, and we went through income broadly conceived. To remind you, it's everything you get except for 2 items. Anybody remembers what they are? Return of capital, number 1, when you get your own money. Is that income? No, you get your own money back. And what's the other one? Borrowed money. Getting your own money back. Excuse me, getting your own money back, that's return of capital. And when you borrow money, okay, that's not income either. All right, so we talked about exclusions, the items the government said we're not going to tax, like gifts, for example, right? And remember, very important conversation from last class also, there are many, many different types of taxes, right? We talked about why they came about, very interesting conversation, very important conversation. We talked about different entities that tax, federal, city, state, municipality. We talked about different types of taxes, federal income tax, state, but also on what? On property, income, on consumption, right? On many, many other things, okay? But what we said was in this class we'll be zooming in on federal income tax. So for example, gifts are not subject to income tax, federal income tax on individuals. Remember? I'm saying on individuals as opposed to what once again? Individuals versus corporations or trusts or partnerships and so on and so forth. So gift taxes are not your income. Once again, gifts are not your income even if you get $1 billion in gifts. But there's such thing called gift tax, which taxes the person who gives a gift, donor. Okay? But donee, who receives the money, never pays taxes on it. Again, separate class, but I want you to be aware of the differences and I wanted to remind you that. And then we talked about the deductions. And there are 2 types of deductions. Above the line deductions, also known as deductions for AGI, in order to arrive at adjusted gross income, and deductions from adjusted gross income, okay? There's a difference between the 2, different types. Above the line examples are IRA contributions, trade or business expenses. Below the line, you have a choice. You could take standard deduction or list item by item, also known as itemized deduction. And whichever is greater, which is amazing, very rarely the government gives you the choice, you pick the bigger one. Okay? And we went through some of the examples and we talked about standard deduction, which is very interesting because the last tax law actually pretty much doubled them, right? Which is pretty amazing. And the most page in your book is this cover of the book and the second page. And the second page has very important amounts, which is standard deductions and exemptions. Okay, and if you pay attention, you'll see that, again, the single went from $6,350 to $12,000. Okay, this is the Trump's changes. Okay, so we went through on the big scheme of things from the bird's eye view, and one of the things I mentioned to you is that at the beginning, first few classes, we'll talk about big picture points. We'll talk about terms we're not quite familiar with and so on and so forth. We'll play that pretend game as if we understand. And with each class, we'll be zooming in more and more in every concept, every proposition. So by the time we come to the first exam, you're all going to be in the same knowledge level. Okay? So before I go and start the discussion of the remaining material of the chapter 3, I want to see, are there any questions on the material that I covered last class, which I now briefly reviewed? Okay. All right. Very good. I'd like to remind you and encourage you to make sure that you see me after class if you have any questions. I always encourage you to raise questions in class, but if you don't have a question, you realize you have a question later, whatever it is, see me after class. As per consumer request, i.e. your vote last class, we'll have our office hours right after the class. In general, I'll finish the class early because we'll have less breaks. So there is no excuse, there's no reason in the world not to see me if you need something, because this is the class's time. This is right after the class, the most convenient thing as you've asked, and I'm happy to accommodate it. So be sure. When we have live lectures like today, like last class, this is your beautiful opportunity to come and see me, okay? Next class. I see already some smiles. Yes, I don't have lecture. Yes. Yes. So next class, next week, Friday, you don't have to come to campus. Okay? So I will post a lecture before the class. Okay? And I hope you're all looking at Blackboard. I've been always using it, and even this semester I posted a lot of good information there. So make sure you're there. Okay? So next class will be online lecture class. I'll post a video of next class, and the homework submitted through the email, which is beautiful. As far as homework goes, just so you know, so I'm going to wait first few classes, maybe 4 classes, till we cover all. I'll come in and we'll just go over every single homework problem that I assigned to date. Does that sound good? Fantastic. All right. Important statement, proposition, announcement, and something you absolutely must remember for the rest of the semester. Because this will confuse you and cause you to make mistakes if you don't happen to remember it. And this is the biggest change in tax law that was enacted. Okay? And I want to make sure you remember it, because from now on, what in recorded videos, for example, about exemptions. So if you look at the tax formula, there's no longer personal dependency exemptions in the tax formula. Okay? The amount for them is about $4,000 that was last year, 2017 and before. Starting 2018, there are no more exemptions. Instead of giving you $4,000 exemption, they doubled your. Very, very, very important point. So please highlight, underline, put a star next to this point. Very important. Okay? 2018 on, no exemption. 17 before, yes, there is exemption. And exemption is simply another amount that the government gives you a deduction for each person, okay, with some exceptions. And we'll talk about it today. But I'd like to stress, so you're going to read in the book, you're going to hear me talk about exemption, and you're going to say, wait, I thought there is no exemption, okay? I know I'm beating this to death, but I know no matter how much I talk about, out of a few hundred of you, I'm still going to get questions. But that's what we're going to study today. But I wanted to give you this big picture because some of you may be confused because you read in the book one thing and you hear another thing. Different years, different laws, things change. And this brings me to a point about profession. You know, a lot of people ask me, so what's the difference between tax versus accounting? One of the differences is that both always evolve, but every time there is a president, okay, everybody wants to change tax code. And everybody always somehow changes it. And, you know, I think for you, this change versus other changes will make things overall simpler, okay? Every president says they will simplify the code, but there's a lot of conversations about eliminating IRS and what's going to happen with tax profession. And I could tell you one thing for sure. Taxes will always be complicated. There's always going to be plenty of work to do, okay? And taxes will never be eliminated because that's the only way for the government to survive. You understand this? So it's a beautiful free franchise if you think about it. You want to make money selling McDonald's, you have to pay them $1 million, pretty much, right? To have their franchise. You want to have a franchise of helping people deal with their taxes and planning? It's free. You just got to know what you're doing. Okay? So just side point. All very new. In fact, it didn't even become operational for 2000 for many items. So So we'll be covering this together, you and me. All right. So with that in mind, we talked about filing statuses, right? Now, one thing I want you to know, when it comes to standard deduction of a dependent, if somebody is somebody's dependent, and again, we'll study what that means in detail, okay? But for now, you could guess, dependent, somebody who is being supported or helped somehow by somebody else, right? So, if you are a dependent, what is your standard deduction? Do you get these amounts or no? Anybody? If you are a dependent of somebody else, okay, not independent. Anybody? How do we come? Excellent. So, basic proposition I want you to write down. Dependents do not get this as a first step, this major deduction, okay? Now, you may think, why? Well, it doesn't matter, that's the law. Now, if you're curious, I could just tell you from policy perspective, by definition, dependents are already being held by somebody else, right? Pretty much. So the government says, maybe we should give them less of a benefit, less of a break. Because deduction is a break. It decreases your taxable income, ultimately what you're paying taxes on, right? As we discussed last class. So the government says, look, for those who are your standard deduction, and we're talking about basic amount first, dependents still get additional amounts, whatever the basic amount is. Okay? So the basic standard deduction is, as we just heard, $1,050. Not $12,000 or whatever, $1,050, or earned income plus $350. Earned income plus $350. I think there's $1 million question out there, and that is earned income. What is earned income?
Anything from a job perspective, but not inclusive of any kind of investments, so unrealized gain or some security.
Exactly. Sometimes it's easier to understand something when you understand what it's not, right? So earned income is not unearned or passive income. So, and passive income is something where when you lay on the beach drinking apple juice and the money is still hitting your account, which is interest, dividends, royalties, and so on and so forth. Is that clear? So earned income, therefore, is when you actually pretty much have to sweat to do something. When you shovel, when you do tax returns, when you dance, when you sing, and so on and so forth. All right? So, for example, if I told you that Marsha, who is a dependent of someone else, earned, let's say, I don't know, $500 selling ice cream. Why ice cream? Anybody knows why ice cream? Summertime? No. Nobody? Because she likes ice cream. So if she sold $500 worth of ice cream, question, what's her basic standard deduction? I want to see some hands. Yes. $1,050. How did you get to $1,050? Exactly. So we're comparing 850 to 1,050, and we get the greater amount, right? By the way, as you're beginning to realize already, and I sincerely apologize for this, and I mean it, but it's really horrible. I have a beautiful excuse for it. Would you like to hear it? And it's a true story, by the way. I'm actually originally from Eastern Europe, former Soviet Union. And there, everybody has to march the same way. And I'm a lefty. But there was no such thing as lefty. There was either righty or what's wrong with you? Right? So, but I would always write with left hand and nobody would ever notice. Until about 4th or 5th grade when they realized what's wrong with you. And they started reteaching me. So now my handwriting is messed up, no matter which hand I use. And in fact, now I'm totally messed up. Because depending on what I do it either with the right or left hand. So I play tennis with the left, but I serve volleyball with the right. I eat with my left. So anyway, I'm messed up in case you didn't realize it. Anyway, so it's 1050, right? And what if I said, what is this deduction? What would be your answer? It depends. Beautiful. Age. Is actually 90 years old and blind. Ice cream and then give it to people so she knows which flavor it is. All right? What would you do? You would take, right? And you would add amounts. Which amount would you add? Depends. Which year are we talking about? 2018, you would add 1,600. If she was single, but she's married, but let's pretend she's single for now. You got it? And if she's 70 and blind, how many times would you add it? 1,600? 2 times. So Marsha's total standard deduction in 2018, if she's single, would be what? 1050 plus 1,600 plus 1,600. And the answer is? It doesn't matter. You could do the math. What is it? 2,000, 3,200, 4,250? Did I get it right? Yeah. Rarely happens. Okay? Is this clear? Any questions? Beautiful. Now let's change the facts. Because I know you guys accountants, you like to play with numbers. That's all you do day and night, right? So what if I told you gross income is $900? Earned income, $900. What would be the answer? I want to see somebody else volunteering. Anybody? Yes. 1,250. How did you get to 1,250? 900 plus 350 gets you 1,250, which is greater than 11. Right? So then it's going to be 1,250 basic amount, then you add if you need to add additional. Clear? Now, what if I told you that Marsha is so good at selling ice cream, she sold 15,000 worth of earned income ice cream. What's her basic amount of standard deduction? Yes, sir. If we're in 2018, now it's going to be 12,000, right? Why? Because it could never be more than. Any questions on this? Don't be shy. Yes. What I said was, if her earned income is 15,000, what would be her basic amount if we use this formula? The basic amount would be 15,000 plus 350 equals 15,350, and it's obviously greater than 1050, so it would be 15,4. Basic amount can, because we're away from people who are dependents, not give them more. We don't like them. In fact, what you'll see, there are a lot of exceptions to 2 categories of people the government doesn't like. Not that they don't like it, but they don't like them. Dependents and those who are married filing separately. We'll talk about that. Excellent. Yes? Oh, because the question was, why did we add in prior example 1,600 two times? The answer is because 1,600 is given per qualification. In my example, Marcia was blind and 100 years old. Right? If she was just blind, she would get 1,600. Excellent, beautiful, fantastic. Okay, so now let's have a conversation about these filing statuses. So as you could see, and we touched upon it last class, and as I promised, we're going to be zooming in more and more. Single filing status. First of all, we determine your filing status on the last day of taxable year. Okay? Now, before we discuss details about filing status, I want to show you something. I want to show you tax table so you could appreciate more fully the significance of the conversation. So, for example, how individuals are being taxed. So, in case of single individual, for example, what you notice is our income. Oh, my tax rate is this, my tax rate is that. No such thing. Your income is taxed like that layer cake, in layers. The first layer is taxed at a certain rate. Next layer is taxed at a certain rate, usually. So if this is your taxable income, the tax is going to be what? 900. And bracket is the layer, the tax applicable to your last layer of income. Between $95,25 and $38,700, the tax is what? $952.50. What is that? Where do we get $952.50? I want to address it now because I know you all will grab your calculator as soon as you leave this room and start recalculating the whole table to make sure it's right, because that's a trend of accounting majors. It's the tax from prior layer, right? Plus 12% of what? Of the amount over $95.25, which is the next layer. You all follow this? Now let's compare it to people who are married. Let's give some good news to those who are married for a change. The 10% rate covers what? From $0 to $19,050. Do you see this? Does that sound like a big deal? It's a big deal. Do you see the difference? It's double, right? Single is $95.25, married is $19. Anybody sees now a reason to get married? Yeah, so it depends, you know? So if one is not making money, you know, and let's say you get $19,000 to keep things simple, right? If you're single, you're going to pay 10% on the first layer and then 12% on the second layer, right? And so on and so forth. But if you get married to somebody who's not working, who's a student or whatever, all of a sudden you pay much less taxes. Do you understand? So a lot of you have a lot of troubles in life. One of the troubles is, how do you pick up people? How do you meet people and establish relationship? That's a perfect pickup line. You come to somebody in the bar and say, hey, how you doing? They've heard this before, nothing unique, but then you strike them with this absolutely shocking line. You ask what? What are you going to ask? No, you say, what tax bracket are you in? They're going to be stunned because they don't know how to answer this question. And then you follow up, in case they're not working, say, hey, you know, I happen to be in 12% tax bracket. So it just happens to cross my mind that if we happen to get married before year end, we could save a lot of money in taxes and I could buy you flowers. Okay? Or you could buy me flowers. So that's exactly why a lot of people get married. No, I'm kidding. But actually, one of the things you'll realize that there's a lot of consequences to getting married and getting divorced. I used to have outside of my door, one of the magazines, there are people getting married and the priest between them. And before they say I do, the priest goes, do you realize the tax consequences of saying I do? I find these things funny. Anyway, so you see the significance. Now, interestingly enough, let's look at head of household. We don't know what that means, right? But we could guess it's when you maintain household when somebody else lives there. Their tax bracket, first bracket is up to $13,600. Worse than married, but better than single, right? Look at those who are married filing separately. We don't know what that means yet, but single. So we'll talk about it. So it makes a difference in many levels, including how much taxes you pay. Everybody understands it? That was my only illustration. If you're wondering about this table, you could play with it at home. But for the exam, you just have to memorize it. That's it. I'm kidding. You don't have to memorize it. So going back to our conversation. So first of all, we'll look at whether you're married or not on the last day of taxable year, December 31. So for tax purposes, are you better off being married or divorced? Married. You're planning to get married during the year. One marriage advice right there. But for lifestyle, is it better to be single or not? I don't know, it depends. But if you enjoy being single, but you have tax benefits, when do you schedule your wedding for? December 31st. Exactly, because you're single the whole day, you do whatever you want the whole year. December 31st you get married, and for the entire year you're considered to be married. You see that? I see a lot of people getting it. Excellent. Okay? In the same time, if you're going to get divorced, putting aside the latest change in law, and knowing that you go better off being married for tax purposes, right? But if you're already getting divorced anyway, you might as well get divorced when? January 1. Because it's going to be same end result on December 31st. Okay? So very important. So when I walk in Times Square for New Year's Eve, and I see these people proposing to each other, after the fireworks, what am I thinking? Idiots. Exactly. Should have gotten married before the ball dropped. Right? You would have saved a few thousand in taxes. I'm actually considering one New Year's Eve to walk around with this. You know how these crazy people walk around with the signs, you know? Their signs say different things. I'm not going to say what they say because some people may get offended. But I'm going to say, propose now! It's going to be late. 5,000 at risk or more. Although sometimes I'm considering walking around with a sign, don't get married. All right. So that's clear, right? So we'll look at the last day of taxable during the year. We'll look at the day of death. Was the person married or not? Okay, if the person was married, it's no surprise they died. No. If the person was married at the time when they died, it means they're married for the entire year. You understand? If you were married single before you said, I do, you're single for the entire year. Is that clear? Any questions? No questions. Yes? Common law, so common law is more like California states, okay? A lot of it covers the entire country. Common law is very few states. We'll talk about general rules here. Common law have their own perspective. If you live with somebody, you consider to be married. Some states consider to be married in other situations. We'll go by federal. All these noises, if you could be so kind to stop, and I talked about it during first class. If you're hungry, and so on and so forth. So, look. common law states we're not going to cover. Anybody curious, I'll be happy to talk about. This is general introductory class. Okay. Now, there is such category in tax law as unmarried. You know what it is? It's when you're married, but you click that undo thing in the word. Kind of. So you're considered to be unmarried and therefore can file a single filing status when you've been never married, when you're divorced, or when you're separated under divorce decree with a separate maintenance. You know, it used to be very tough to get divorced because, you know, people these days wake up, have wrong breakfast, that's it, I divorce you, I don't love you anymore. Well, they're really saying, I don't love the way you do breakfast anymore, right? So they run to get divorced. So New York State used to be more strict. They say, wait, how about you just live separately for a year, see if you really want to get divorced. Now it's much easier again. But still, if you're separated in divorce decree, which means there's agreement, decree from the court or agreement that you've reached that says we're living separately, separate maintenance, separate households, you consider to be single too. You understand? Which is unmarried. Okay? Then you could file a single filing status. Now remember, you have a choice. Sometimes you may be eligible for more than one filing status. You pick the one that's better for you, and that's an important thing to remember, which gives you bigger deductions and so on and so forth. Okay? Yes? We'll talk about widow. Maybe, maybe not. We'll talk about widow. Okay? Because there's filing status called qualifying widower. Okay? So very important. Now, quite often, when we talk about death, there are a lot of questions. Okay? Like how to file, what standard deduction. We'll come back to all these conversations. Don't worry about it. Now, since you mentioned widow, let's talk about widows. There's a filing status called qualifying widower or surviving spouse. Excuse me? Same thing. Yeah. What does surviving spouse stand for? It's a spouse that survived the marriage. In other words, one spouse died, the other one survived. Okay? Separate filing status. Now, how do we deal with this situation? How do we deal with this situation? Okay? Mr. David, I could give you a chair and I'm just not going to move. So, how do we deal with the situation? There's a separate filing widower which allows you, even though your spouse is no longer around, write down, for 2 years, 2 years following the year of death, to file as if you were still married. In other words, same tax rate schedule, okay, that you could use, as if you were married filing jointly. Very important, I repeat. Qualifying widower status, if you qualify, allows you to file your tax returns using married filing jointly schedule for 2 years after the year of death, if you qualify. To qualify, what do you have to do? Anybody remembers from reading? You have to have, yes. You have to have a dependent child, and please underline the word child. Very important. Who lives in your household. Very important. Dependent child who lives in your household. Okay? This is very important. You have to have a dependent child who lives in your household. We'll talk about again how one can qualify as dependent, but this is very important. Okay? So, we got single, we have married, we have surviving spouse, okay? Now, what about married filing separately? That's interesting. By the way, for those who are curious, if you look at text table, even the text table says married filing jointly or qualifying widower. You see? It's the same tax schedule. Now, if you are married, you have an option of filing your tax return separately, which means instead of putting all of the income and expense of the family on one tax return, on one form, so to speak, you say, let's keep it separately. Honey, I love you, but you keep your stuff, I keep my stuff separately. And you report your income expenses, your spouse reports his or her income expenses separately. You understand? Government doesn't like it. Why? Because first of all, it creates double amount of work for them because it's now 2 tax returns to go through, not 1. You understand? Question. Is it good for you to do that? We just looked at tax table, for example. Are you better off doing that or worse off? Worse off. Well, you're right. Based on what we saw, it's definitely worse off. But there could be a situation where you may be better off. That's where the answer depends comes in handy here. So that's going to be my question. Can you tell me why in the world, if you're in the worse off tax table, why in the world would you file separately if you're married? Yes?
You as an individual have really large items you can deduct that will surpass the 24,000 threshold, and you would individually want like medical expenses.
Excellent. So since you bring up medical expenses, why don't we talk about it? So for example, one of the itemized deductions that we discussed are medical expenses, right? And how do we deduct medical expenses?
More the amount of 8,000? No, 7.
So depending on the tax year, okay, but the latest, something that you, for 2018 on, is 10% of AGI. In other words, you could deduct amount that exceeds, the amount that exceeds 10% of adjusted gross income. So let's say, and the best way to, again, understand these concepts is through examples. So let's say your AGI is $100,000, okay? And if I told you that your medical expenses, let's say, $14,000. On exam, how much in itemized deduction can you deduct? A, 0. B, 14. C, 10. D, some other amount. What's the correct answer? D, some other amount. What is the answer? 4,000. Because when we talk about, and you see that example in casualty losses we'll study, we'll now talk about medical expenses, I promise we're zooming in on things more and more. It says deductible subject to 10% floor. Floor means the floor, the first 10% of AGI, not deductible. AGI is our adjusted gross income, remember from the tax formula? So in this case, 10% of 100,000 is 10,000. Up to 10,000, you don't get to deduct your medical expenses. It means you're not sick enough relative to your income. If you're going to get sick, you better get sick to get tax benefits. Now, sometimes one spouse makes a lot of money, 100,000. The other spouse makes not so much money. But if they file jointly, they would not deduct much of it, right? So this is where if you file separately and your AGI is low, you could get to deduct, for example, medical expenses higher. It may make sense. Everybody understands it? So that's one good reason. Any other reasons why, while you are married, you would file separately? You would want to file separately? Anybody? 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 Yes?
Sometimes, like, for instance, the other spouse may be owing IRS.
The other spouse what?
Maybe owing IRS with some back taxes. So it's like if you file this year, together with your spouse, meaning there's no refund coming home.
So first of all, the answer was, for everybody to hear, that if your spouse owes some back taxes. By the way, again, going back to marriage very important. Not a bad idea before you get married to find out all the debts your spouse has, including tax debts. Okay, I see a lot of people taking notes. Yes, write it down. Okay, very important. So now, just because you file future tax returns with your spouse, it does not make you responsible for back taxes of the other spouse. So I just want to have the record clear. But if your spouse owes taxes and let's say you expect refund from the government, they may be able to keep it. So that's a good reason. Very good. Any other thoughts? Why? There's a fundamental reason why. And the fundamental reason why is, and I want you to know, ladies and gentlemen, when you sign the tax return, joint tax return, you become, the legal term is jointly and severably liable for everything that's in that tax return. What does it mean? Well, first of all, if taxes are owed, let's say your spouse made the money, didn't pay taxes, but it's a joint return you file for that year and you sign, you are responsible for that taxes. Doesn't matter who made the money. So if ultimately you get divorced, IRS could still go after you. Is that clear? That's point number one. Point number two, if there is fraud in tax return, if your spouse is lying, remember, for lying on your tax return, you could go where? Jail. So if you sign tax return, it creates joint and several liability, you're personally responsible. So some people say, honey, I love you, but I want to have anything to do with your tax return. You file your stuff separately, I file my stuff separately. You got it? This way you're not responsible for what's going on in the other tax return. Now, quite often, the spouses who just sign return, sometimes there are a lot of spouses who just don't get involved in financial activities. It's the other spouse who handles. They just sign everything. They claim, well, I'm innocent. I didn't know. Okay? So there is a provision, for those of you curious, known as innocent spouse provision, that says if you truly did not know and had no reason to know, then we're not going to put you to jail or go after you. You understand? But that's different from what's known as willful blindness. There's a term, legal term for it, willful blindness. What it says is, if you knew or should have known, oh, honey, I see you making all this. Okay, don't tell me. I don't want to know about it. I'll just file my tax return. No, that's not good enough. That's willful blindness versus really not knowing. It's like, oh, honey, new Mercedes, beautiful. And all that on $15,000 we make a year? Okay? Are we clear on this? We all understand? Okay. Very good. By the way, when we talked about standard deduction, since we're talking about those who are married filing separately now, this is a good time for me to mention that when you file separately, let's think about it for a second. Government gives you standard deduction, or it lets you itemize, right? This creates an interesting opportunity, because let's say you have $10,000 in itemized deductions, and let's say $10,000 in standard deduction. What a bummer! Because you cannot get both, right? You have to choose one. So you lose essentially $10,000. So one brilliant person came up with the idea, said, honey, let's file separately. I get standard deduction on my return, and you take itemized deduction on your return. And we'll live happily ever after. So the government came out, realized that this is what people were doing. They came up with a law that says, for those who are married filing separately, if one spouse itemizes, the other spouse must itemize also. Cannot take standard deduction. Please write it down. No double dipping, Because remember, the government says it will give you either this or that, not both. That's logic, right? So if one spouse itemizes, the other spouse must also itemize. Any questions? Questions? So what we do today is very fundamental class. I just give you some fundamental material because we need something to work with for the rest of the semester, okay? And then on that, we're going to build stuff and plan stuff, and you'll see how it all plays out. But for now, it's like when you came to a different country. You got to pick up some language, otherwise you cannot talk to anybody. Okay? No questions? Yes?
Question, if you, let's say, separated but still married, can you still file marriage separate?
If you're separated, but you're still married.
Yeah.
Remember, well, if you're on this divorce decree separated, then you're considered to be unmarried. Yeah, remember that falls onto that category. All right, so the last filing status that we'll talk about is head of household, which is very important filing status. Okay? To be, and I'll remind you, we'll take a break at about 1 o'clock, okay? As we've discussed and agreed and you've asked. Now, head of household status, as we've noticed, is something in between. Okay? It's between married and between single, kind of middle ground. That's if you have a dependent, okay? So, in order to be able to file as a head of household, you have to be number one, unmarried. Okay, you cannot be married and filing as a head of household. So you have to be unmarried, that's number one. And number two, maintain household for more than half a year. Maintain household for more than half a year. For your dependent relative. For your dependent relative who lives with you. Okay? And please underline, highlight, and put a star next to the word relative. That's a $1 billion word. We're going to talk a lot about it, what it means. And by the way, what it means really in reality, like who your relatives are. Do you know that you actually have no clue who your real relatives are? We'll talk about it. It's important to know because Thanksgiving is coming up soon. You really need to know. And you're up for a very pleasant surprise. There are some people who you always wondered what planet they were in are actually not your relatives. I'm being very serious. So we'll talk about it. Okay? But for now, you have that down, right? Now, the exception to this rule is for parents. Parents, grandparents don't have to live with you. You could kick them out to nursing home. As long as you pay for the nursing home or help pay and they're your dependents, no problem. You could still be head of household. Yes?
So the residency test doesn't apply to those?
Does not apply. So the residency test, which means have to live with you, does not apply for parents or grandparents.
And one more. The head of household, the qualifying relative, do they have to live with you the whole year? Or
Okay. So now this beautifully transitions us. So we talk about all these relatives and qualifying relatives. So who are these people and who are our dependents? And let's talk about that, right? Okay. So I have fantastic news for you. Would you like to hear fantastic news? Amazing news. Mind-blowing news. There's a beautiful concept summary in your page. It's probably the only thing that I love about the book. Everything else I like. And it's a better book out there. So that's why. So this is concept summary 3.2, page 15, chapter 3. My suggestion, this is so valuable, this is so good, it's so clarifying, you should rip it out of your book and post it right by your bedside. So when you go to bed, you wake up, you look at it and you smile. Okay? So there are actually two ways to have a dependent on your tax return. Now, my lovely people, I feel for you, okay? But I want to remind you one more time. Remember exemptions that you used to get about $4,000 as a deduction? You get that for yourself. You get that for your spouse if you file joint return with your spouse. Please write it down. And you get that for each dependent you have. So if you had 10 dependents, that's $40,000 right there in extra deductions about, right? Because you get that $4,050, whatever that exact amount is, doesn't matter, exemption amount on your tax formula. Remember tax formula, guys? Remember in tax formula, after we're done with deductions, we come to personal and dependency exemptions. Again, does not exist in 2018 and on, but 17 still existed, right? Some of the problems in the book are going to deal with 2017. You need to know it. Okay? Same possibly with the exam. So in order to get exemption for yourself, you automatically get it. And what is the amount of exemption? Right here, it's 2017, 4,050, 2018, 4,150. You see that? It's just additional deduction the government gives you before they start taxing you. That's all. So you get it for yourself. Yes?
Oh, but it's not in like 2018 on, why did it go up?
Why did it go up if exemption, you don't get a deduction for exemption 2018? Excellent question. The question was, why it's here for 2018 if we don't get it anymore? And it changed also. Excellent question. Thank you. The answer is, things are not as simple as we would like them to be. So even though in 2018 on, you no longer get this amount, but the rest of the law, the rest of the code is still there. And one of the things you'll study in a moment is that in order to have a dependent, like for example for filing status, you have to have a dependent. Who is your dependent? One of the requirements in order for a person to be dependent, their income cannot exceed exemption amount. So we still need to know exemption amount, even though you don't get it, but to see whether somebody is dependent or not, for example. And therefore, which filing status you file. Everybody got that? Very important. You'll see how it plays out as we practice. So, ladies and gentlemen, welcome to the world of dependence. Even though it's not as meaningful and important after 2018 on, but you still need to know it because you need to know who your dependent is in order to know what filing status you're in, even though you don't get exemption for them anymore. Understand? And there are other reasons why you need to know that too. All right. Two ways. One is qualifying child. Another one is qualifying relative. Okay? These are like two paths. Think about it as a way to get out of Manhattan if you're driving to New Jersey. I don't know why in the world you would want to go to New Jersey. Separate conversation. But if let's say you want to do that, right? You could take, for example, Lincoln Tunnel. You could take Holland Tunnel. You could take Washington Bridge. You could swim. All right? So that's the same way. You want to get somebody as dependent for tax purposes, again. We're only talking about tax. You want to get dependents other ways. We could talk about afterwards. But for tax purposes, it's qualifying child or qualifying relative. Now, each path has its own requirements. So let's talk about it. So if we talk about qualifying child, first test is relationship test. Okay? And it beautifully summarizes it. And this is something very counterintuitive. I love counterintuitive stuff. I teach about counterintuitive intelligence. But this is beautiful. Because this was before the current administration. Prior administration enacted a law that simplified the tax code. And they created this whole new way to get people as dependent as qualifying child. But you look, and there's nothing but child there, because qualifying child dependent doesn't even have to be a child. So first of all, relationship test. Who qualifies with the relationship as your child? Answer. Your child. That's good. But also, excellent. So first of all, anytime we say child, okay, we're also talk about foster child, adopted child, stepchild. You guys know the differences? No? You don't watch enough soap operas? So let's see. Foster child is when parents are, for whatever reason, unable to take care of their children. They're generally alive, but maybe they're drug addicts, maybe they're injured, whatever. So there's fostering families that foster them, right? Adopted child is when you adopt somebody else's child and legally becomes your child. I'm sure you've seen plenty of shows on that, right? Like, it doesn't matter. And what's the other? Oh, stepchild. I'm going to teach who, like, the relationship within the family. Now you'll really understand who people are when you meet them. And stepchildren are children of your spouse, right? Pretty much. So you get married and your spouse had children prior to joining you, not your biological children, but biological children of your spouse. Clear? Okay. Beautiful. And then all the other relationships, step-brother, step-sister works exactly the same way. All right. So it's your child, and therefore step, adopted, or foster, right? Who other people go under you? How do we call them? We're going to play YMCA test today. Okay? But we'll come to it in a moment. So people who go under you, we call them descendants, exactly. So actually, your dependent child, well, the formal category, remember, is qualifying child. It's a term of art, legal term, qualifying child. It's your children and descendants of your children, your descendants. So it's also your grandchildren, your great-grandchildren, also your qualifying children for the purpose of dependency test. You understand? Also, your siblings, exactly. So that's your brother and sister. You got it? And not only that, it's also their what? Their descendants. So how do we call those guys? Nieces and nephews, right? Now I'll teach you about family relationships. Now, general rule, your qualifying child cannot be older than you. But there is an exception to this rule. If they're disabled, exactly, then it's okay to be older. You got it? Questions? So that's a first test, relationship test. Any questions? Straightforward, right? Residence. Okay? Abode test. Qualifying child generally has to live with you. Okay? Live with you for the entire year. Okay? Now, there are some exceptions to this rule. If there are good excuses why the person doesn't live with you, then we'll count it in. Like, for example, military, hospital, prison. Okay, these are qualifying absences. Or full-time student, right? And you don't even have to be a full-time student for the entire year. How long do you have to be a full-time student?
5 months.
January, February, March, April, and part of May, right? In January, usually there's not even studies, right? So, very important. Age. Under 19 or full-time student under 24 at the end of taxable year. Your dependent has to be under 19 or full-time student under 24. Okay? Support test. When it comes to qualifying child, the child cannot be, it's very counterintuitive here also. You would think support test means you have to support somebody, right? No. In qualifying child, as long as child is not self-supporting, it's okay. Which means what? Somebody else could be supporting the child. It's okay. As long as child is not self-supporting. You got it? Excellent. Gross income. This is an important item. It does not apply to qualifying child, but you see how it's going to come into play. Okay, we'll come back to it. Less than exemption. That's why we needed to know exemption, that question. Okay? But we don't care about a qualifying child because that's not on the test. Joint return test. It actually should have said no joint return test. No joint return, because in order for you to claim somebody as a dependent, as a general rule, they cannot file a joint return. You got it? But there is an exception to it. Yeah, there's a lot of exceptions in the law. I select which ones I expose you to. In this case, it says, look, even though your spouse filed joint return with somebody else, it's okay. It's okay. It's okay for you to get exemption if we're in 2017, for example, to claim that person as dependent, in other words. As long as the only reason your spouse filed joint return is to get a refund from the government. Okay, that's it. As long as the only reason spouse filed tax return with somebody else to get money from the government, it's okay. Now, you may be sitting there, well, why it sounds like a little bit convoluted? Well, the truth of the matter, the truth why this provision is still there, they haven't changed it, they should have changed it, but they didn't, is because this was also, whoever you claim as dependent, remember, you could get their exemption on your return. So, but there's only one exemption the person has, $4,000. And if I grab it, nobody else could have it. We don't want one person's exemption to be getting received and benefited by spouse, but also by that person themselves, or parents if they support the spouse, you know? It cannot be two parties claiming the same person as dependent, bottom line. So this rule used to say, if your spouse files, if your dependent files joint return, you cannot get $4,000 if that dependent files return and pays taxes, because that means they're already benefiting. There's a risk they may benefit from their own $4,000 exemption. But it's not as important now. So the only thing you should know at this point is, in order to claim somebody as dependent, they cannot file a joint return with anybody else. And if they do, it's okay only if the only reason they file is to get a refund. Then it's okay, even though they're married, you could still get them as dependent. Is that clear? Any questions? Okay. So the last test is citizenship. Question? No questions? Last test is citizenship. No, don't be shy. Okay, there are questions, that's why we're here. Yes?
The question is about what you just said. So you said it's okay, but at the same time you said that that person who is claimed as a dependent cannot get an exemption?
Nobody gets exemption in 2018.
Yeah, I know, but in 2017.
17, correct. So if they file tax return with somebody else, it means, it doesn't matter. Yeah, joint return. It means you cannot claim them as dependent. So you don't care what happens there. So the person always has their own $4,000. If they want to claim it, they could claim it. Yeah, remember, you lose your $4,000. You know, I used to describe this as you're born. You know how there are saints and they have this thing, if you look at paintings, these things above their heads? So I used to describe that you're born with $4,000 above your head. All of you walking around. And it's a good way to remember things. So on your tax return, you could always get it. Now, if somebody grabs it from you, somebody who claims you as dependent, it's gone. So you don't have anything to claim on your return, or even if you file with somebody's return, you can't do that. It's gone. Okay? Because it could be 2,000 can only be used once on behalf or for one person. That's it. By the way, your value is going to go up as we go through the semester. Pretty soon you're going to be walking around with $250,000 above your head. That's when we talk about real estate investments. You'll see huge benefits you could get. All right. So last test, citizenship. Okay? And all it says is your dependent must be a citizen. Your dependent must be a citizen or a resident of the United States or our neighbors. Mexico and Canada. Okay? That's it. Very simple. Now, after class, I usually have some students coming to me and say, hey, my uncle came here illegally. Can I claim him? So we have immigration class right after this class. Those who are curious, this is when we talk about all that stuff. Okay? Any questions? Yes?
So you said that to file as head of household, you have to have a dependent relative?
Yeah, I'm going to come back to that. I'm going to come back. We didn't quite finish yet, conversation about who's your dependent. So this is one way to get somebody as dependent, okay? Now there's another way, qualifying relative, okay? So who are your qualifying relatives? All right, everybody, please put your pens down or pencils. I want everybody to get up. We're going to have a mid-inning stretch. And also, I'll teach you how to do YMCA dance. I could see some faces. Oh no, I have to get up. I've been so comfortable for 2 hours in the same spot. All right, so let's talk about who our relatives are, ladies and gentlemen. And then you'll write down. I know you're scared. Don't break. This is not a Greek wedding. We're not breaking anything or whatever. So, raise your hands up. Put your hands in the air like you don't care. Who are relatives above us? How do we call them? Ancestors. That include, keep your hands up. Imagine you're in this concert hall. Go like this. We're going to do some yoga here too. All right, so ancestors, these are who? Parents, grandparents, great-grandparents, right? Very good. Who else are our relatives? Descendants. These are our, we already discussed. Who are they? No, you got to get with the program, hands down. It's a different dance move. Okay, next one is but later. So these are children, grandchildren, great-grandchildren, right? It points towards the earth, right? This is where they get you. They get you. I love my 3 kids, just for the record. Then, let's go like this, just don't hurt anybody. Who are these people? Siblings, your brothers and sisters, right? Ah, so now you said the dirty word. Did you guys hear what she said? All right, so first of all, sit down. Good job. Now you're prepared for the club night and nightlife. So first of all, write down on the qualifying relative, your relatives are your ancestors, your descendants, and now a lot of you are better prepared for soap opera watching because you know now all the relationships and you know which relationships are legal and illegal. So your ancestors, parents, grandparents, great-grandparents, your descendants, children, grandchildren, great-grandchildren, your brothers and sisters, okay? Now, in-laws are also your relatives, believe it or not. So this is the moment when I see who's married, who's not. Because the sad faces usually are very married people. They know what it means to have in-laws. And I love my in-laws, again, for the record. So, brother, sister-in-law, father-in-law, mother-in-law, these are all your relatives. And guess what? Even after you get divorced, your in-laws still stay as your relatives. Legally, for tax purposes. Okay, write it down. Is that good or bad for you, by the way? Nah. See, depends doesn't work all the time. It's actually good for you because now you're able to claim them as dependents. You have to provide the support. Why in the world would you do that? Well, some people do that. Some people have better relationship with in-laws than with spouses. Okay? Forever! So actually you remarry and then you get divorced again. You just inherited another set of in-laws. So if you're looking for people to support, a lot of people, big armies, just keep marrying, getting divorced. Okay? Now, you said the dirty word. Cousins. Ladies and gentlemen, are you ready? It's going to come as a stunning shock. But I'm here to tell you. Yes, I know people already, some begin to cry. Cousins are not your relatives. Please write it down. Please highlight, underline this statement. This is a very important statement. Some people are happy looking at each other like, oh, we're not relatives. Ah, this creates some opportunities. No. Strike that. Mr. David, please erase it from the video from last class. And all the other jokes I made last time and this time. We'll presume all of them were inappropriate. So, cousins are not your relatives, okay? Now, why? Good question. I don't know. Maybe because somewhere down the line we're all relatives. We're all cousins. I don't know. And then there are different categories of cousins, right? Once removed, twice removed. You go back far enough, we all came from Africa, you know? We're all cousins. So cousins, not your relatives, okay? Now, when you look at the relationship test, interestingly enough, it's relationship or member of the household. So actually, you can meet relationship test through two ways. One way is if it's somebody is your relative. Another way, if they live with you. Either one or the other. For entire year. So for example, your boyfriend or girlfriend, can they be your dependent? Yes. So let's analyze it. Are they your relatives? No, but can they be your dependent? Yes, if they live with you for the entire year. You with me? Your friend, can friend be your dependent? Yes, if they live with you for the entire year. And now $1 million question. So can cousins be your dependents? Yes, if they live with you for the entire year. Are cousins your relatives? No. Can they be your dependents? Yes, if they live with you for the entire year. Why am I stressing this? So now, let's go back to our conversation about filing status. Head of household. Dependent must be who? Your relative who lives with you. So, if I give you a question on exam, Mary, 46 years old, has a dependent, Charlie, who is her cousin. Question number 1, can Charlie be her dependent? Yes or no? Yes. Question number 2, can Mary file as head of household? No. Why not? Because it's not enough to have a dependent to be able to file as a head of household. Your dependent must be your relative. This is historically drives 3% of the classroom. Because people say, I am confused. You said cousins could be dependents. Yeah, so why can't you be head of household? Because they're not your relatives. But how come are they your dependents? Because they could only be dependents if they live with you. And this is going to be ongoing with few people for the rest of the semester. So why don't you reflect on it right now? See if you have questions. Yes?
So if it was his son and he's like 5, he would qualify?
Qualify for what? Head of household?
Yeah.
Yeah, because his son, your relative. Remember YMCA dance? Either you could go either qualifying child route or qualifying relative route. It doesn't matter. It's like 2 ways to get to New Jersey. It doesn't matter. Right? Yes.
I have a question about the gross income. So you said that it cannot be even more than...
We didn't talk about that yet. We'll get there. For now, where are we in our talk? We are talking about another way to get to New Jersey, to get somebody as dependent, and we're still here. Who is your relative? I want to make sure we're clear. Because you still have to satisfy all these other requirements. But we didn't get to them yet. So are we clear on the relatives? Yes. If cousin lives with you, you file a head of household, no problem. Question on exam. Cousin lives with you as dependent and your child lives with you as dependent. Can you file as a head of household? Yeah, because you only need just one dependent who is your relative. Well, the answer is yes, unless there is a qualifying excuse, remember? Which is school, prison, army, and all that stuff. Right? That's under qualifying child. But under residence, look. So let's continue. We didn't quite talk. You're asking me next question. So let's continue walking through, and then I'll come back to your question. So are there any other questions on relatives? Okay, yes. Could you be so kind to repeat your question again? If you cannot file as the head of household, oh, one has nothing to do with the other. The question was, if you cannot file as a head of household, how can you claim somebody as a dependent? Your cousin. One has nothing with the other. You could file as single and still have dependents. I didn't say that. I said in order to file as a head of household, you have to have a dependent who lives with you, who is a member of your household. That part is true. But I didn't say in order to have a dependent, they have to live with you. They don't have to live with you, as a matter of fact. The only requirement, and this is where we're going right now, because the second test is member of the household, right? Live with taxpayer for the entire year. So the only people who are required to live with you, again, are those who are not related to you. Like cousins, friends, boyfriends. Your relatives under this tunnel, qualifying relatives, do not have to live with you to be your dependents. Don't confuse two things that have nothing to do with each other. how do I claim somebody as a dependent versus what filing status do I file as. You could file as any filing status and still have dependents. In order to file as a head of household, your dependent must live with you, except for parents or grandparents, right? Those could be nursing home, we said. But to claim somebody as a dependent, if you're claiming them under qualifying relative test, if you look at that, there is no requirement to live with you. They don't have to live with you. Your child, your sister could live anywhere. Now, if you want to claim somebody under qualifying child category, then they have to live with you. So there are two ways to claim somebody as dependent, okay? Now, what you need to do, as I said, this is very fundamental material. I'm giving it to you. That's why I request that you read before you come. With this lecture, you come home and you have time to digest, and then you, whatever questions, remaining questions. But this is why I very much encourage you to read in advance, prepare questions, because you come already not only better prepared, but also you already know what you don't understand, and you walk out perfect shape. But this is all good. This is all beautiful. I'm happy to answer as many questions as you have. Okay, I'm just saying if you want to simplify your life, try to kind of tackle these questions. And I try to push you in that direction by assigning homework in advance, so it kind of makes you do that. Yes? What if you have what? If you have foster kids we say no different than any other kid. Then you don't have them. Well, depends on the requirement. Where are you bringing them in? So if you remember, foster child is your child. So under qualifying relative category, they don't have to live with you at all. So it doesn't matter if they live with you, as long as it's your foster child. Now, if at the end of the year they're not your foster child, if you're playing soap opera with me and they took away, then there is no foster child anymore. Now, if you want to claim foster child in the qualifying category, right? The requirement is they have to live with you. So you got to figure out where you are. But for head of household status, the requirement there is for more than half a year. So you could still file as a head of household when you had foster child in your possession. Okay? Oh boy, see me after class. You already lost me. Son or daughter of your half-brother. First of all, half-brother is your brother. Son or daughter are, how do we call them? These are your nieces and nephews. Nieces and nephews are descendants of your brother and sister, fall under qualifying child. They're not your relatives. They're your qualifying children. Therefore, to claim as dependents, they have to live with you. Okay? I just love this. So my cousin's stepsister's brother adopted foster child. Professor Melnick, how do we treat them? I don't know. I don't know who they are. So what I'd like to do is, I'd like to finish going through qualifying relative category, and then I'll summarize and we'll review the whole thing again, just to solidify it further. Okay, we'll finish it. Qualifying relative category, and then we'll review everything again. All right. By the way, as you've noticed in the book, when it comes to medical expenses, 10% does the new law that's kicking in after this year, right? The floor. Through 2018, including this year, the floor for medical expenses is 7.5%. Again, that's another change. You may want to note it. So 2018, 17, it's 7.5% floor. After the 2018, starting 2019, it's going to be 10%. Okay? All right. So we talked about qualifying relative way to get somebody as a dependent. Okay? And again, why are we talking about it? You need to know who your dependent is if you have dependents, so you know which filing status to file as. So we talked about relationship. We talked about member of the household. Okay, again, these are people who are not your relatives, but they could still be your dependents if they live with you for the entire year. Okay? Unless, again, there are good excuses, which we discussed, good exceptions. Now, residence, as you see test, does not exist in qualifying relative category, so they don't have to live with you, okay? Unless, again, they're not related to you. You understand? Then the only way to get them as relatives is if they live with you, member of the household, okay? Now, age, it doesn't matter, as you could see, under the qualifying relative, doesn't matter what the age is of the person. They could be 150 years old. It doesn't matter, they could still be your dependent. Your parents could be your dependents. Okay? Under, again, qualifying relative category. Okay? Support test, now that gets interesting because while we said under qualifying child, you don't have to support them as long as there is no self-support. In qualifying relative, you actually have to support them. So let's talk about that. What does it mean when you support somebody? It means you provide more than what? More than half, right? So more than half of what? Basic expenses. What are your basic living expenses? Living expenses, shelter, food, clothing, medical, education, right? And you see whether you provided more than half. If you provided more than half, you satisfy test. Now, I'd like to make something crystal clear, just in case you don't remember from reading or don't see it. It's not enough to satisfy any one of these tests. In order to claim somebody is dependent, you have to satisfy all of the tests on the qualifying relative, if you want to claim somebody as a qualifying relative dependent, or all of the tests on the qualifying child, either one. Mistake that is usually made in an exam by students is you go on the qualifying relative, you see, it's a relative, done. Wrong. It's not enough. You also have to satisfy all these other tests. You understand? So now we're talking about support test. So the general rule is you have to provide more than half, as we said. There are situations where, for example, kids love their parents so much that all of the kids want to support parents. Let's just pretend these things happen, right? And then, let's say if we have, 4 kids, let's say, right? Equally contributing 25% each, can any one of them claim as dependent their parents under the general rule? No, because you have to provide more than half. So exception is made on the support test, and it's called multiple support agreements. Multiple support agreements. And what it says is, if a group as a whole provides more than half, right? So now you individual don't have to provide more than half as long as the group as a whole provides more than half. If group as a whole provides more than half, then any member of the group, any one member of the group, right? Any one member of the group can claim person as dependent. Now, any one member, in parentheses, please put down who provides more than 10% of the support, right? You have to provide something meaningful. What's meaningful? Congress said more than 10%. So if a group as a whole provides more than half, any member of the group who provides more than half, more than 10%, can claim the person as dependent if every member of the group, every other member of the group Again, parentheses, who provides more than 10%, right? Otherwise, you have no right to say anything. You just give $1 and you have a problem. Who cares? So again, let's start from the beginning. As long as a group provides more than half, then any one member of the group who contributes more than 10% can claim dependency exemption, as long as all other members of the group who provide more than 10% agree to it in writing. And I'll repeat one more time. As long as the group overall provides more than 10%, provides more than 50%, more than half, right? Any one member of the group who contributes more than 10% of the support can claim dependency exemption, claim someone is dependent, as long as every other member of the group who also contributes more than 10% agrees to it in writing. Why do we have such agreement in writing? Because we don't want to run a risk that multiple people are going to be claiming the same person as dependent. So we want proof. Show us the writing. And the only person who could claim, who provides, okay, you don't provide more than half, at least provide more than 10%. Okay? Is this clear? Any questions? First of all, let's be careful and clear. Not 10%. You have to have more than 10%. Big difference. Whether you get credit in the exam or not. Go ahead.
That's more than 10%. Means more than 10% will go up.
No. Oh, good question. Good question. The question is, what's 10% of what? Of what group provides overall? No, that's overall support. Out of 100%. Right? And as long as, again, you satisfy all the other requirements. And the group members have to satisfy all the other requirements. Yes?
Yeah, that's actually my question. So the group, let's say if the cousins also support, they cannot claim, right?
Cousins can never claim you.
In the multiple agreements, I mean, if they provide 20% of support and then son provides 20%, so cousins cannot, even if son will write it down.
So your question is, can cousins, if they satisfy support test, claim somebody as dependent?
No, you said just anyone from the group
Can what?
can claim the dependent.
As long as they meet all other requirements.
Okay, so they have to
In order to claim somebody as dependent, you have to meet all of these requirements or all of these requirements. Support is just one of them. So going back to your question about cousin, yeah, if cousin satisfies this support test, that's great, but they still have to satisfy relationship. So again, is it possible for cousin to claim somebody as dependent? One more time. Is it possible for a cousin to claim somebody as a dependent? Yes, if they live with you.
Okay, so let's say they live with that cousin, so he can claim. I mean, I'm confused.
First of all, you gotta have a clarity. Whom are we talking about right now? Person who's gonna be claiming somebody, or person who's being claimed? Where are you? In your thought, you're not sure. So you have to. Of course, it's the same homework problem. That's the whole reason I assign homework problems. So you think about things in advance. So we'll go back to, see, I told you, there's going to be still conversations about it. So let's go back to basics again. Can you claim somebody who's your cousin a dependent? Yes. You could claim them as a dependent. Can you ever claim a cousin as a dependent on the qualifying child? No. So you could only claim your cousin as dependent on the qualifying relative category, right? In order to claim somebody as a qualifying relative, one of the tests is support test. So you have to provide more than half or be a member of the group that provides more than half. That's fine. But you also have to satisfy the relationship test. Are you relatives with somebody who is your cousin? No. But there's another way, another X here. How can you satisfy, what's another way to satisfy the relationship test? If you live together for the entire year. So if you satisfy the support and you live with your cousin for the entire year, you can claim them as a dependent. Okay? I understand it can be confusing, but as long as you write down these 3 sentences clearly in your notes, you're done.
It's just confusion because of that new rule that you cannot, put an exemption, so.
But it doesn't matter because, yeah, you cannot claim them as the exemption, but who cares? We're not talking about exemptions. We're talking about who is your dependent. Whom can you have as a dependent? And the question is, can you have cousin? That's it. The exemption used to be simply consequence of having somebody as a dependent because you could have an additional $4,000 in your tax return. But that's just a consequence. First, you still have to establish under any law and under any year who is your dependent.
What's the benefits of that?
The benefit, as we discussed, is if you claim somebody as dependent, you could now file as a head of household.
But not in the case of a cousin.
Not in the case of a cousin. Correct.
For the cousins, what the purpose to bring someone as a dependent? Nothing. Just
For our purposes, they may not be a purpose. Yeah, they may be eligible as your dependent, but you don't get the benefit. You're right. You're right. Yeah, but you need to know that. You need to know that. So if on exam you're given the cousin as dependent, if you tell me you could claim them, you could file as the head of household, there's going to be a wrong answer, right? That's all we're talking about, right? And for 2017, you need to know that, and before, that if you have a cousin as dependent, you get their exemption. For 18 on, it doesn't matter. For 17, it does matter. Yes, and by the way, just so you understand, and I don't care whether you're in tax world, I don't care whether you're in accounting world, I don't care if you're in the legal world, if you're in a world of finance, rules will always be changing. And anytime rules change, the beautiful thing about this beautiful country is unlike other countries where the government says, from now on, rule is changed and anything you've been doing so far is illegal, you have to redo the whole thing. One of the benefits of this beautiful country is Constitution, which says, as a general rule, you change laws proactively, not retroactively, right? So for example, why all of a sudden, let's say, alimony payments, right? You cannot deduct them starting next year. Why not? Nobody could deduct. Why not say, alimony deduction, not deductible at all? Why not say that? Why? Because when people in the past agreed to pay alimony certain amounts, they took into consideration the fact they could get a deduction. Now to tell them you cannot deduct anymore, that's a destruction to them because their cost becomes much bigger. So this is one of the examples why the laws change proactively. Now, anytime you change laws proactively, not retroactively, you're going to be in the situation you're in now where here on is this set of rules, here on that set of rules. And it will always be the case no matter what you do in your life. This is just your opportunity to experience this in this particular class. Same thing with FASB announcement and so on and so forth. For an accounting world, provision applies to these years but not this year's and so on and so forth. These assets, not this, that. And you always have to be mindful where you are, what you're dealing with. Okay? Yes?
For the multiple support agreement, can a different person claim them as a dependent each year?
Yeah, there is no need for consistency. Unlike accounting world, we don't care for consistency in tax world. So this year, you're better off getting deduction because you made more money. You could save more taxes, you claim. Next year, you claim. One of the things you'll learn, we're going to study that later when we're going to talk about filing times and tax years. We'll look at 1 year at a time. It's like these horses by Plaza Hotel. They have these blinds. We only generally care about this year, what happens this year. Okay? Good question. Last question, and we're moving forward. Yes? Yeah, your cousin could satisfy one of the two relationship tests, this particular one that I circled, if they'll live with you for the entire year. No, either one or the other. Yeah. Because it's one test, relationship test. And you can satisfy it either by having somebody as a relative, this is our YMCA test, or they live with you. Okay? Good question. Thank you. All right, so age, as I said, we don't care about what the age is on the qualifying relative. And support test, we just discussed. Now, gross income here has to be less than exemption amount, as we discussed before. So whatever the exemption amount particular year is, in order to claim somebody as a dependent, their income has to be less than that. If their income is more than that, you cannot claim somebody as qualifying relative. So if somebody, question everybody, if somebody makes $1 million, can you claim them as a dependent? Yes or no? Who says yes, raise your hand. Who says no, raise your hand. Wrong answer. It depends. It was a tricky question. It depends. Why? What does it depend on? Because there is no income test under qualifying child. So you cannot claim them as dependent on the qualifying relative, but you could claim them. So your child who's just born, making $1 million, pooping in the Pampers, starring in that commercial, you can still claim them as dependent. If you satisfy all the other requirements. So for example, if your child doesn't self-support, doesn't use that money, no problem. Okay? So the test is under qualifying relative has to be less than exemption, whatever that amount is. Okay? In particular year. The other two tests, joint return and citizenship, are identical in both cases. Okay? So let's step back. Again, big picture moment. Guys, we have to appreciate big picture in order to get it. What are we talking about again? We're talking about the way to claim somebody as a dependent. Why is it important? Main reason it's important because this will tell you how you could file in terms of your filing status, for example. There are other reasons we'll study later, but for now, how you could file. Because if you are head of household, you have to have a dependent relative, right, who lives with you, which is a general rule. Right? So you need to know who your dependent is. But it's not enough to have a dependent for qualifying head of household. The dependent has to be also your relative. So cousin's not good enough, right? This little situation there. That's the first reason you need to know who your dependents are. The second reason you need to know, because for the years 2017 and before, you also get additional amount exemptions. Okay? So you'll have to watch which year we're talking about. Now, there are two ways again. I'm repeating this for the 10th time, but I want to make sure you guys got it, okay? Even though on the replay video, you could just keep playing replay and I don't have to repeat it now. But nevertheless, there are two ways to claim somebody as dependent. Qualifying child or qualifying relative. Each one has requirements. In each one, you have to satisfy all of them, okay? So on the qualifying child, it's got to be a relationship there. It doesn't have to be a child, right? Residents, they have to live with you. In the case of qualifying child, I want to make it clear in case there was a confusion or misconception, or maybe I misspoke, I don't think I did, but it doesn't matter. Under qualifying child has to be living with you for more than half a year. Under qualifying relative, if somebody's not your relative, for them to qualify, they have to be living with you for the entire year. That's the difference. Everyone with me? So here, the requirement is entire year. Here, more than half a year. And in both cases, we have excuses. Full-time student away on campus, hospital, whatever, military, that will count as if the person is living with you. Everybody understands it. There should not be any confusion on this. Support test, again, not self-supported qualifying child. Now we're comparing the two. In qualifying relative, you have to support more than half, will be part of the agreement. And then there is gross income, which is only in qualifying relative. It does not exist in qualifying child. And children. Now, do you understand why this structure, this concept summary is so important. Because this will save you so much trouble. It wasn't always in the book. Author just came up with it, and I love it. I used to actually map it out myself for students, okay? It's very recent, couple of editions. So you gotta be friends with this, because this will immediately tell you, okay? So I want you to know this. Now, review this, you'll do homework on this. If you'll still have questions, I'll be very happy. But I think we beat it to death today, okay? And I know you agree with this. So, and I understand it's confusing. First of all, it's a new world, new material, all these interconnected things, you know? I get it, but that's okay. You're going to be perfectly set. Just make sure you took good notes. You'll watch the video, you'll watch it again. You know, it's a holiday weekend. You have absolutely nothing to do but to watch my videos, right? Between the burgers and the grilling. 2 and 2, by the way, go beautifully together. Okay? And you'll be in perfect shape. So, and you see what I'm doing? You know, this is not usually how it's taught, but I'm teaching you subject and let's say filing status, and there's a conversation about dependence. So now we talk about dependence, so you see the connection between the two. Not as disconnected items, because then you have to kind of figure out how to put it all together. Okay, so you follow your notes, and you'll be beautifully set. Now, we were talking about filing statuses, right? So another thing, so I want to go back to that conversation about filing status. Again, single, married, filing joint. You have to file tax return where you have a dependent who is your relative who lives with you, but your parents, grandparents don't have to live with you, right? Beautiful. Now, it said that one of the requirements is you have to be unmarried, remember? What if, ladies and gentlemen, what if you're married, happily married, as far as you are concerned? You have your dependent, relative, everything's good. You wake up in the morning one day, you go like this, like this, like. Your spouse is gone. What is the first thing that comes to your mind? How am I going to file, right? Why is this the first thought? Because in order to file joint return, the spouse has to be there to sign jointly. The spouse is gone. In fact, there's a note on the pillow says what? What does the note say? It says, you've been abandoned. Yeah, that's exactly what it says. So what do you do when you're abandoned? Now, how do you file? Can you file as single? No, because you're married. You can't file. You're not divorced. You're not under a divorce decree. So you cannot file as single. Can you file as married filing jointly? No, because the person is not there to sign. And you have no clue where they are. So what's your only option? Wait, you cannot file as a head of household because you have to be unmarried. Surviving spouse, that's only if you find that spouse and kill that spouse. Then you're going to be surviving spouse. That's only for those who died in action or outside the action. So what's your only option right now? Married filing separately. And that's horrible. And this is why you're really crying early in the morning. Because you realize how bad it's going to be. And then you go what? Wait a second. When I was in Professor Melnick's class, we studied an exception to head of filing status, head of household status, and it's called how? Abandoned spouse. And it says what? Anybody remembers? even though you are married. Even though you are married, if you have not lived with your spouse for the past 6 months of the for the last 6 months of the taxable year, right? It's all in your book. You did not live with your spouse for the last 6 months of the taxable year. And you cannot file a joint return. And you have a dependent whom? Be careful, be careful, be careful. Child. You have a dependent child. Again, very important. Please underline, highlight the word and put a star next to the word child. Not dependent relative, not dependent, dependent child. Not qualifying child. Because in the qualified child category, you could stick in nieces, nephews, grandchildren, brothers, sisters. No, no, no. It's got to be qualifying child. Who's your child? A child means, again, adopted, foster, step, that's fine. Then they allow you to file how? Head of household. Not married filing separately. And that's when you remember that and you start going, yes, I've been abandoned, but my taxes are okay. It's not as good as married filing jointly, but it's not as bad as married filing separately. We got it? Okay, questions. Let's start from the back. Yes? You're screwed. I'm sorry. For the record, the question was, what if they abandoned you 5 months before the year end? You cannot file head of household because you don't satisfy the requirement. So you guys heard of prenuptial agreements? It's not a bad thing to put in prenuptial agreement. If you're going to abandon me, please make sure you do so 6 months before year end. Okay? Any other questions? Now, when I say you don't live together with spouse for 6 months, let's be clear here, because last semester the student asked me, what if you live in different bedrooms? And that usually follows up, what if you sleep on different sides of the bed? No, that's not good. Okay? Although technically speaking, if it's a two-family house, but that's not abandoned really. Anyway, any other questions? Yes?
So if the spouse is abandoned, but they don't have a child?
If the spouse is abandoned and you don't have a child, you're in trouble. Then you just have to file married filing separately. There is no other choice. You cannot file single because in order to file single, you have to be unmarried, which means not married, divorced, or separated on divorce decree, separate maintenance. You don't have that yet when you're abandoned. What you can do, you could go to court, file saying I've been abandoned. By the way, there are some states that will annul your marriage if your spouse disappeared for a long enough time. But that's marriage class, which meets after immigration class, after this class. Okay? Any other questions?
The ex-husband can be your relative? It was
Can your ex-husband be your relative? You have to be clear what you're really asking me here. Are you asking me, can you marry a relative? That depends. I know, I'm kidding. So I understand what you're asking me. What you're saying is your ex-husband or wife or something else, they could be considered your relative for the purpose of you claiming them as a dependent. Right? What's the answer? Yes! So the answer is, once again, the answer is it depends. So, in the year of divorce, you cannot claim them as dependent. But you're absolutely correct. Thank you. Year after divorce, yes, you could claim them as dependent.
years or year? Just one year.
For years after divorce. All those ex-husbands. Yes. Same with the ex-wives, by the way.
Two-part question. So, if you are the abandoned spouse,
If you are the, wait. If you are the, you mean you've been abandoned?
if you're the one that,
Oh, you are the abandoning spouse. Okay, shame on you, first of all. What's the question?
that person would still be married while
Great question. The question is, okay, fine, we've been talking about the person who's been abandoned, but hey, things may not be as sweet for the person who's been abandoning, ing. So let's talk about that person. How does that person file? Great question. Answer. Same answer. Same answer. They have to file as a married filing separately unless they have a dependent child. Right? And they may have a different child than a dependent child of the first spouse, right? It doesn't have to be the same child. Maybe that's why they're abandoning now, finally. I know you had two-part question. What's the second part? Shh.
if one of the spouses does, if they file as head of household and the other does married filing separately because they don't have the dependent child, if the one that does married filing separately decides to itemize, then
I love the question. Because what you're doing, you're putting together everything we talked about pretty much the whole time. So now, spouses being abandoned, one files, let's say, it doesn't matter how, but let's say you said head of household, the other one married filing separately. But what really matters, you said, but one of them itemizes. Uh-oh. Yeah. So that means the other one absolutely have to itemize. Cannot take standard deduction. You're absolutely correct. So the natural question comes out, how do I know? I've been abandoned. If he or she talked to me, I would have much more information than how they file in their damn tax return. You're right. The answer is, you may not know. Which brings me to the bigger point, and that is, when you file your tax return, whatever you put on your tax return, you have to be able to support. If you cannot support, you cannot put it on your tax return. The burden of proof, in other words, is on you. So what do you do if you don't know? That's a tough situation. It's a tough situation. Whenever you're in this situation, keep in mind, if you're ever audited by the IRS, there may be consequences. So you really have to try to access your spouse. Say, hey, I understand the abandonment situation. I just want to know for tax purposes. How many children do you have outside of our marriage that you're claiming as dependent? And all the other things. But, you know, that becomes a difficult situation. Because if you take a standard deduction, what if they took itemized, right? You cannot do it. If they're itemizing, and so the default would usually be you have to itemize to play it safe. But even that doesn't really help you. What if the other person takes standard deduction? You know? So it's going to be a situation. It's going to be a potential issue you deal with.
But on that case, because for you, you are no filing on the married filing separate status. You are filing on a different status. So an itemization, that itemization clause applies to married filing.
Brilliant point. The point is, hey, maybe two spouses are not filing as married filing separately altogether, and his question still applies. Well, you don't know what your spouse is doing, really. Because if you don't know, if you have the information that they filed as head of household, then you're going to know what's going on, right? Then it's not an issue. So what his real question was that I was trying to answer, what if you don't know? That was his real question, right? What if you don't know? But you're absolutely correct. If one files as head of household, the other one is married filing separately, it's not an issue, right? Because we said before, married filing, if you file as married filing separately, that's when this law kicks in. That's one itemized, the other one has to itemize. So there's a lot of issues involved, but as long as you understand how things into play, sometimes the answer may not be clear or may not be available because you may not know. And you may have to change your return once you find out. Okay? Beautiful. Absolutely fantastic. And since we are talking about filing statuses and standard deductions, and we said standard deductions for regular person is on the table, right? Basic amount, and there's additional. Dependents get it differently, right? And now we already talked about who dependents are. By the way, we talked about already one situation when taxpayers do not get standard deduction, and we just reviewed it again. That's when one spouse itemizes, married filing separately, right? The other one must also itemize, does not get standard deduction. There's one more category of taxpayers that do not get standard deduction given to everybody else. Non-resident aliens, very good. Whatever that means, it doesn't matter. Okay? But there's one category we'll come back to, those who are sole proprietors in certain situations. But we're not going to talk about it right now. Okay, so we did phenomenal work today. So before we discuss anything else, what I'd like to do is to give you homework, because you're saying, oh my God, we still didn't get homework. So, I gave homework last class. I also posted it on Blackboard for those of you who weren't here. I hope you've been checking it out. So homework for next time. Are you ready? So first of all, when is it due? On or before 11 a.m. Friday of next week, and you email it to me, right? And you know where to email it to? Same place you emailed last homework. And those who don't know what Blackboard yet is, this is what it says there, assignments3300@gmail.com, okay? But it's also on the Blackboard. So homework for next class, chapter 3, problem. I'm going to go slow so we don't have to repeat many times. Problem 34, 38, 40, 42, 44, okay, that's from chapter 3. And as I told you, I want you to read ahead. Always be chapter ahead in reading from where we are. So on that point, from chapter 4, I'd like you to do just two problems, 33 and 36. Chapter 4, problems 33 and 36. Let me just quickly take a look at something before we go anywhere else with anything else. I just want to talk about one more thing before we finish. Okay, can I do that? Yeah. We have plenty of time, but it's not going to take too long. So we talked about filing matters, and to file you need to know your filing status. And to know your filing status, you need to know who your dependents are, right? So now I want to talk about who has to file. Who has to file? Okay? Is everyone has to file return? The answer is no. Now, who has to file? The rule is very simple. It's any taxpayer whose income, gross income, equals or exceeds what? Up until 2017 and before, it was a sum of standard deduction plus exemption. Who has to file? The answer is individual has to file if his or her gross income equals or exceeds the amount of standard deduction plus exemption. Okay? Excuse me? Can I say it again? Sure. Individual has to file tax return if his or her income equals or exceeds the amount of standard deduction plus exemption. Okay? That's for 2017 and before. Okay? Since we eliminated exemption deduction, things became easier for the year 2018 on. So, for the year 2018, individual has to file if their gross income equals or exceeds what? Standard deduction. You got it? Now, remember what standard deduction means. Standard deduction means the sum of basic amount and additional, remember? So when we calculate total standard deduction, please pay attention right now, very important. When we calculate standard deduction right now for everybody, we do not give additional amount for being blind. Oof. Just write it down. So individual has to file 2018 on, for example, if their gross income equals or exceeds standard deduction. Okay? But write down, but when calculating standard deduction, you do not get additional amount for blindness. Why? Write a letter to your senator. You still get it for age, exactly. Because as a policy reason, we gave blind people additional amount so they could get exemption, another purpose, even though it's no longer applicable. But when it comes to do they have to file, do they not have to file, we decided not to do it. Political discussions. Okay? You got this? Now, if you are married filing separately, people we don't like, you have to file your tax return again for the year 2017 and before, when your gross income equals or exceeds your exemption amount. If you're married filing separately, you have to file your tax return for 2017 and before if your gross income equals or exceeds exemption amount. Okay? One way to remember that is if you're married filing separately, generally you lose standard deduction, right? If the other person items, but if you like it, you don't have to remember that. From 2018 on, if you are married filing separately, you have to file no matter what your gross income is. Why? Because we eliminated exemption. So now the threshold is 0. So if you're married filing separately, you always have to file tax return. You're required, because the conversation is who's required to file. You don't have to file, right? If your whatever situation is, but if you're married filing separately, you have to file your tax return, no matter what your income is. You got it? I'll repeat one more time, even though on the video you could make it repeat 100 times. Again, 2017, gross income equals or exceeds standard deduction plus exemption. Married filing separately, gross income equals or exceeds exemption. That's it. You must file. 2018, must file if gross income equals or exceeds standard deduction. For married filing separately, any level of income, even 0, you have to file. Okay? When it comes to dependents, At what level do dependents have to file? If you look in your book on the page 3-21, okay? And there are three possibilities. Well, filing requirement for dependents, if you read them, it says, well, they have to file if their earned income only and gross income is more than the total of standard deduction. Then you read, if they have unearned income only, then it's $1,050 plus any additional amount. And if they have both, bottom line, in vast majority of cases, I'll give you an easy way to remember it. Dependents must file if their gross income equals or exceeds also their standard deduction. But remember, standard deduction is not what's given to everybody else. It's the way we calculate standard deduction for dependents, right? And what's dependent standard deduction? Remember? It's $1,050, or earned income plus $350, right? Whichever is greater, plus any additional amounts, remember? For being blind or 65 and over 65. So please note, very important points when it comes to dependents. Number one is, they have to file if their gross income equals or exceeds their standard deduction, no matter what the year is. It depends. What's dependent standard deduction? It depends. Do they have earned income or not? It's either, because remember again, you have it in your notes from today. Standard deduction is, of dependent, basic amount is $1,050, or earned income plus $350. Remember exercises about Mary, the ice cream selling? Okay? But please also write down additional point. Dependents do get additional amount of standard deduction for being blind and over 65. Others people don't get for being blind. Dependents get additional amounts here for the purpose of calculating whether they have required to file or not. They get additional amount for being blind also and over 65. So I'll repeat yet another time. So when it comes to dependents, in determining whether they have to file or not, we'll look at their gross income. And if their gross income equals or exceeds their standard deduction, which is going to work in the vast majority of the cases, they're going to have to file. Now, you just got to remember, how do you calculate standard deduction of dependent? It's not, you don't just go to the table, look at the basic amount. It's $1,050 or earned income plus $350, right? It could never exceed what's given to everybody else basic, plus additional amount for being blind or over 65. Okay? Any questions on this? Now, when it comes to filing requirement, the only last person we're talking about is self-employed. Self-employed people have to file if their earnings equal or exceeds $400. They don't get $12,000 standard deduction. They don't get $1,050 or plus earned income, $400. Why so low? Can somebody tell me? Why do those who are self-employed have to file tax return at such a low level? Anybody? Yes.
Maybe because they can itemize for items, for expense.
You're getting warm.
Maybe because there is no additional proof of their income.
You guys all getting warmer and warmer. The answer is, we don't trust them. Because they run their own books, they run their own business, nobody sends them W-2 to show how much they earned. We don't trust them. So you earn more than $400, file tax return. There's an interesting case where IRS came to audit laundromat, you know, where they throw quarters? And the family was reporting like $18,000 for the year in income. And IRS came to audit and said, that's all we're making. IRS determined almost to the penny that they actually made $130,000 in income for the year. Question, how did the IRS figure it out? They observed, they stuck around, they went back to that year in the past, observed how many people. There were no video cameras.
If they come back another time, see what we
They could estimate, they could say, hey, the business improved this year. Just because IRS is here, you're watching, people are curious, coming to wash clothes more than ever. Anybody else wants to guess? Since you guys sitting together, you could talk in the same time. No, let's start with you first. Yes. Red flags came up. Well, yeah, red flags came up. They made 18,000. They were driving nice cars, but that still didn't tell them they made 130,000. Yes. Comparable companies? Yeah, could be, but still doesn't show 130,000 this company made. Yes. Whistleblower? Not in this case. Yes. They looked at their expenses. Which expenses? Yeah, you got there almost completely perfectly. Now you just got to take that answer next level. Utility expenses, water usage. You look at the water bill for the year, you look how much cycle or electricity each cycle takes, and you calculate how many cycles for the year multiplied by the cost, that's your revenue. Wow. You didn't think IRS agents were that smart, right? They're very smart, and they're very good people, and I have a lot of friends there. All right? So I think it's enough for today, okay? Anybody that has any questions, I very much encourage you to come and see me now. Otherwise, I'll see you when I see you. But next class will be online, and please make sure you watch Blackboard for the announcements. Have a good weekend and everything else.